give you both sides of that teeter-totter. What it's like when your side's going down and what it's like when your side's going up. So as I look at the S&P 500, what do I know about this index? Well, the first thing I know about this index is that it wasn't a real index that anybody covered specifically until 1957. So everything before 1957 is hypothetical. Now, what the academics have done is to recreate what they think the S&P 500 would have looked like. And remember, the S&P 500, those stocks are chosen by a committee. So now you're second guessing a committee. But because there are so many companies in the index, I suspect that the return is a fairly legitimate representation. And the first thing that we look at here, not just the time period on the far left, but the range of annualized returns. Annualized, whether it's 1 year, 2, 3, all the way through 40 years. So you can see the very best and you can see the very worst. Now, these are calendar years. That's very important because as I look, for example, at the range of annualized returns for the S&P 500, the worst calendar year was a loss of 43.3%, including the time from 1929 to 38. Now, that is the worst calendar year. If we looked at 12-month periods so that every new month is starting a 12-month period, or even better yet, we simply looked at some point in time, the market stops going up and starts going down. And by the time it reaches its bottom, what they call a drawdown, and then comes back up to where it started, that amount, for example, in the 2000 through 2009 period, 2 times the S&P 500 lost 50% or more. So, in fact, this study does not represent the worst of times. So, it's looking at calendar years. That's important. So, what do I know when I see 1 year at a time? Well, when I see 1 year at a time, if I just looked at the average CAGR, compound annualized growth rate, in the third column over, you'll see that the average 1 year return was 11.8%. Now, when I say that, I want to apologize for all the times I've yelled and screamed that one of our competitors, another teachers whose work I do not respect, he will make the case that the average return for the S&P 500 is 12%. The problem with that is when you look at pure averages, that the impact of losing is not as great as the impact when we compound the return rather than looking at average returns. So if you have an investment that you put $100 in and it goes up 50%, the first year it goes to 150, and the second year it goes down 50%, it goes down to 75. And yet the average return was zero. So average returns overstate the compounding return that you're likely to experience. But for the sake of consistency, Daryl has kept it the average CAGR for all of the different periods. By the time you get out to 40 years, it's a pretty good number. But that's a long time for most investors to be thinking. Here's what I know. I know that for the 1 year at a time, that range is from a minus 43.3 to a plus 54. Now, when people are asked, what do you think? And I'm talking about experts. What do you think the market's going to do next year? Most people come in and around the 10%. We'll use what the compound rate of return has been. If they're a little more aggressive, maybe they'll use 12%. But they're rarely calling for big ups or big downs. From my viewpoint, the reality is, from what I know about the past, that you could lose 40 to 50% of your money next year. Nobody knows what the next year will bring. And you could have a year you're up over 50. It happens. And you're going to see that with each one of these either individual equity asset classes, or you're going to see it as a combo of several. So you can see here that Daryl looked at 95 separate one-year periods. And out of that, 26 of them were losing years, which basically tells me that I've got to be ready. In fact, that translates into 27.4% of all the years were losing years, but about 1 out of 4 years, I should expect to lose money. It could be a lot, it could be a little. But that's an important thing to know, because if life looks like historical averages, it's a little uncomfortable to know you're very likely to lose, and by the way, a fairly substantial amount of money. Even when you look at all 2-year periods. Now, keep in mind, when we go to looking at 2-year periods, that would include 28 and 29. It would include 29 and 30, 30 and 31, 31 and 32. You are repeating some of the past history when you do that. And so it is always statistically more meaningful, I'm told. I'm not a statistician. I'm a student and a teacher of what I've learned from others, and they say it's better not to have these overlapping periods. Let them stand on their own. Well, in this particular study, Daryl has shown whether it's the 2, the 3, the 5, you're going to pick up something from the past in your return. By the way, that does mean those terrible, terrible years back in the early 30s, they are in essence out of the way fairly early in calculating these averages. So if they had come in the middle of this 95-year period, then it would have had a greater impact. But that's just one of the things we need to understand. Anyway, what I see here is you have to go all the way out to 10 years and look at the rolling 10 years, and you are still historically experienced a 10-year period that you lost 1.4%. And as a matter of fact, if we go all the way over to the right, you'll see there were 4 10-year periods that the S&P 500 lost money. Now, I am sure some of that is a matter of overlapping periods. But that does mean that it is not impossible to put your money in today and 10 years from now, the value of that money, not even taking into consideration inflation, the value of that money has gone down. And that's what people found out from 2000 to 2009. It happens. And that is why one needs to, when they go from working to retirement, And depending on their investments in retirement, a lot of people are going to, for sure, have some fixed income there to protect against the downtimes. But then when I look beyond 10 years and look at the 15-year periods and the 20 and the all the way to 40, all of those were periods that there were no losses when you looked out 15 years. Now, having said that, remember I said inflation is not considered here. So when I look at the worst 15-year period for the S&P 500, I want you to notice that there was a period that the compound rate of return for the 15 years was a gain of 0.6% a year. But when I'm talking on May 29th to the seniors at Western Washington University, they should not be worrying about those early years being bad. And in fact, I'll show you in just a second how some of the worst years in history could be on your side, on your side. So this you'll notice, once you get out beyond, actually, if you look at the average CAGR for 2 years through 40 years, it's almost the same for every period, the average. But the range for 40 years, and this is important to those seniors, for the S&P 500 was a compound rate of return, the worst 40 years, of 8.9%, and the best 12.5%. And let's remember, every extra 0.5% could be worth another $1 million to $2 million once you're in retirement and over your retirement and what you leave to others. So I would love for you to experience the 12.5 rather than the 8.9. Now, you'll also notice that as you start at the top, the very best return for a year was 54%. When you go to 2 years, it drops down to 41.7. When it's 3 years, 31.2. When it's 5 years, 28.6. These are the compounded annualized returns. And then 20.1, and it keeps going down and down and down. So at 40 years, the very best 40-year compound rate of return was 12.5. So it will matter when the good and bad times come, and you'll see that in just a few minutes. But my hope is that this gives you a real view of what could happen to you as a young investor. You could start out and things don't do well for an extended period of time. In fact, let's look at small cap value. Small cap value is an asset class that instead of the company's billion being worth over 100 billion, many of them over 200 billion, many of them over $500 billion. Instead, small cap value is companies, they are companies that are $3 to $6 billion in capitalization. That means if you multiply the dollar, the market value times the number of shares, that will tell you what the public thinks that company is worth. These are small companies. And these are companies that are out of favor, sell for lower PE ratios, as an example, than the more popular growth small companies. But I want you to see, and we're going to have an easy way to compare all these numbers in a few minutes. We're going to see that Small cap value, if you remember, the worst year with the S&P 500